Okay, everyone, how are you today? My name is John O'Donnell. Thank you for coming to my webinar. And this is my email address if you want to email me for any reasons, john@tradingacademy.com. I'm the Chief Knowledge Officer at Online Trading Academy, which means that I do a lot of research. Where are all you folks located? I see over 100, 77 people in the room. How many of you have heard of Online Trading Academy before? It's nice to see. Looks like we got people from all over the world. That's great. Like the United Nations is represented here today. The title of my talk today is 2009 Market Forecast, Perception versus Reality for what I call the new normal era in Globalization 3.0, Credit Bubble, Deleveraging Purge. Now, for those of you that never heard my presentation there, if you go at the end of this, to go back to FX Street's website in the webinar archive section, I believe they have 4 of my 2008, early first quarter 2009 webinars posted. And what this is going to be today is an update on the theme that we see at Online Trading Academy playing out across the world, which is going to impact all markets. It's going to impact currency markets, metals markets, equities markets, bond markets, and I want to try to give you my overview on what seems to be the trend that we're observing here at Online Trading Academy. Now, for those of you that don't know about Online Trading Academy, we're the world's largest school. We've been in business for 12 years. We teach all kinds of classes. Just go to our website. You'll see lots of information posted there. But we have about 30 offices across the world, and we will soon be opening offices in Australia and India. We are in 5 countries presently, and we are truly a global direct access trading school for multiple asset classes. Now, the theme that I choose to talk about is what I call Globalization 3.0, which I believe will be an era of accelerated change. Change is what creates risk. Change is what creates opportunity. Now, there have been 3 eras of globalization that we want to look at. And Globalization 1.0 was from 1492 to 1800. That was financed by monarchy capital. Think of the United Kingdom and Spain. That was a very different era, given the technology of its day. Then we moved to Globalization 2.0, which was the period of time between 1800 and 2000. Many call that the start of the Industrial Revolution. But that was financed with private capital, not monarchy capital. Think of IBM, Coca-Cola, GE, Nestle, major multinational corporations that were out creating new markets. But you and I now live in what we call Globalization 3.0. It started around the end of 2000. That's when the Internet really became commercial and scalable. It's probably going to run for 150 years, so none of us on this webinar are going to outlive it. But it's a remarkably different period of time because it's financed with individual capital, human capital, from 3 billion new players. And there's really no place to hide in this new era. Now, these people are from India, Eastern Europe, South America, Middle East, virtually all over the world. And they're going to become the producers of the goods and services of the goods and services the world wants, and they're going to be consumers of goods and services as their standard of living rises. And in our world, this is going to create an accelerated rate of change. Now, let's take a look at the Globalization 2.0 period of time. This was from 1800 to 2000. Now, I'm using the performance of the U.S. stock market in constant dollars as my barometer for the past 200 years. Note, I'm using the dividend-adjusted market index in 1999 constant dollars. Now, I don't need to tell this audience what a constant dollar is, but for those of you that haven't figured it out, it's the purchasing power parity of the U.S. dollar vis-a-vis a basket of global currencies. And I want you to know that we had alternating, look at this, boom, bust, boom, bust, boom, bust cycles. Now, this is a price-to-resources ratio, which takes about 6 econometrics and measures this whole period of time, and it shows us a different picture. It shows us that we had 8 unsustainable bull market periods of valuation, and I want you to note that none of them were sustainable, without exception. And then we had 8 bear market valuation extremes, and note that none of them were sustainable either. Now, our vision of the future in this, as we transition to what we call the new normal, and we'll talk about that a little bit more in a moment, is that this trend is going to continue, except with the following change. We think the peaks are going to get higher, we think the valleys are going to get lower, and we think these cycles are going to get more compressed and closer together. In other words, going forward, we're going to have more volatility, not less. Now, I think there's a great opportunity for us to trade in this environment, and there's really no place to hide. What do I mean by that? And let me give you an example of what I mean by transitioning. Even if you're an English princess, there's no place to hide from this phenomenon of Globalization 3.0. Now, that means you and I need to adjust our trading and investing plans, even our career paths, in this new era. Think about this as an example. A young English princess with an Egyptian boyfriend crashes in a French tunnel, driving a German car with a Dutch engine, driven by a Belgian who was drunk on Scottish whiskey. She was followed closely by Italian paparazzi on Japanese motorcycles. She was treated by an American doctor using Brazilian medicines. Now, this is being explained to you by a third-generation Irish American. That's me. I happen to be using Microsoft code written in India. You're probably reading this on a computer that uses Taiwanese chips, a Korean monitor, assembled by Bangladeshi workers in a Singapore plant, transported by Indian lorry drivers, hijacked by Indonesians, and unloaded by Sicilian longshoremen in a port of call here in Long Beach, California, to a Japan-produced truck using Saudi hydrocarbons, all this being then delivered to your home by an illegal driver who enjoyed for lunch Italian pasta, Swiss chocolate, and Budweiser beer that, by the way, is now owned by a Belgian-Brazilian management team. Now, ladies and gentlemen, that's Globalization 3.0. This is the era that you and I must adapt our lifestyle, and we need to adapt it quite quickly. Now, here at Online Trading Academy, we think there are 3 work synergistically to drive the global economic change. And it's not just a U.S. economic change that we're transitioning to. It's the whole world, because all of these markets today are interconnected and impact one another, because there's a huge flight to safety going on. Number one, the implosion of global trade. We'll talk about that in a moment. That's a very big part. There's about $60 trillion of global GDP that's executed each year, and global trade, which is trade between country A and country B, is becoming a bigger piece of that pie all the time. The second leg of this stool is the implosion of the household balance sheets. I don't know, for those of you that are not familiar with what's going on in America, 1 out of 5 homes, that's 20% of the homes in America, now have negative equity. We haven't seen that since the 1930s. Secondly, our unemployment rate, which we'll talk about in a moment, is now officially up over 9.5%, but certain states are bumping up against 15-20% unemployment. We'll talk about that in a moment. And if you don't have a job in America, it's very difficult to service your mortgage and perfect your consumption pattern. Now, America, it's very important that the American family, which is about 5% of the world's population, about 300 million strong, we consume over 24% of what the world produces. So we're the ultimate consumer of last resort for many finished goods and services. This is all going to change dramatically as we Americans change our consumption pattern in this deep recession. And of course, the third you've all read about is the implosion of the banking sector, where assets have become, that credit has become impaired in some particular sectors. It's virtually non-existent today, and it hasn't recovered at all. Now let's talk about world trade, because world trade is in contraction. It's creating an environment of global job losses, and it's creating an environment of anemic or slower consumption. Now, this is the year-over-year change in total exports for 15 major countries from 1991 through 2008. And you can see here at the top that global trade, we had some very robust periods of global trade on the positive side, a couple of negative areas. But here's where we are today. Here in 2009, we're seeing a tremendous slack in global trade. Now, the year-over-year change, country by country, in total exports, as measured in U.S. dollars, has also had a big impact on the foreign currency market, of course, and the equities market, not only for America, but all these countries. Look at China here. Their year-over-year change in total exports has dropped 41%. Taiwan's down 41%. Japan's down 38%. France is down 33%. Germany 32%. Look at the U.S. down here, down 22%. So although things are tough in America, because we are a consumption-based economy, our anemic consumption change pattern has impacted these other countries who produce the goods that we consume, in many cases, in a much more dramatic fashion. What we're seeing in America today is a relatively new phenomenon, and I took this quote off Bloomberg on June 17th, and it said, the cost of living decreases in America by the most in 6 decades. So we are well into a global slowing consumption pattern, and we'll talk about what caused all that in a few moments, and we'll talk about the impact and forecast of it going forward. But ladies and gentlemen, I think you need to adapt your trading plans that this era very well may stay with us for a significant period of time, and we'll talk about in a moment why we believe that is the case. This quote on Bloomberg said, the cost of living in the U.S. fell over the last 12 months by the most in 6 decades, easing concern that government efforts to revive the economy, primarily through deficit spending, will lead to an immediate outbreak of inflation. The Consumer Price Index and the Producer Price Index, for that matter, as well. But the CPI dropped over 1.3%. That was the most since 1950, according to the Labor Department. So I think that inflation is not an issue. Matter of fact, I think there are huge amounts of slack in the economy, and demand, quite frankly, in almost all sectors is quite soft. So it's difficult for price inflation to pick up the balance of this year, probably all the way into the summer of 2010. At least that's our forecast. Now, what we're going through in our world is we are transitioning to the period of what we call, and by the way, PIMCO calls, the new normal. Now, what we're going through in our world is a Darwinian purge. You see, capitalism is about survival of the fittest. Not everyone can win in capitalism. Now, these are some of the major financial brands in the world. I'm sure all of you on this webinar are familiar with these companies, and some of them today have ceased to exist. I believe we're going to continue to see a lot of pressure on major financial intermediaries in the financial services space, and it truly is going to purge out the excess capacity in this model. I have a 20-year-old son, and he told me, by the way, he didn't like this word purge, so I suggested my son give me a new word for this webinar today, and he suggested a word that may be more descriptive than my word. He suggested flush, the Darwinian flush of the system. And that's exactly what we're going through. Now, ladies and gentlemen, it's happening in multiple sectors, in multiple countries, and the net effect is that the weak players in each space, and then we'll go on to the next bull market growth cycle. Now, let's take a look at what's happening in America in what I call the socialization of risk. Now, we haven't seen this massive government intervention in the financing of anemic producers in America, well, maybe ever to this degree, but think of the automobile industry, Ford, Chrysler, GM in America. Two of them are in bankruptcy. As a matter of fact, GM just emerged from bankruptcy last week, and they shed themselves of over $130 billion of debt. Now, where did that debt go? Well, in the bankruptcy procedure, both secured and unsecured creditor debt is converted into a new classification of shares. So debt is converted into equity. The plants that are not needed are closed. The employees and vendor contracts that need to be adjusted are done so. And these companies will go on and live a new life. Now, what is still unknown is if Ford, GM, and Chrysler can produce the kind of automobiles the world wants in this new environment. It's pretty clear that there's going to be a demand for transportation going forward, but yet we're going to see some new players, some new global players, specifically from India and China, that are going to have a lot to say about the evolution or the global purge of the automobile sector as we transition to what's next. Now, let's talk about unemployment. At the end of the day, consumption in America, which is again 70% of GDP, if you consider that the fortune pattern is a very, very big part of the world economy. And if you're a producer of goods and services that you wish to ship to America for we Americans to consume, you have to be quite concerned today because, well, quite frankly, our social mood is dramatically changing. And it's primarily driven by the fact that our unemployment rate is escalating. The official national unemployment rate in America is presently about 9.5%. Here in California, where I live, as of May, it was up over 11.5%. Meredith Whitney on CNBC forecasted yesterday that the unemployment rate in America is well on its way to over 13% in this cycle. Now, let's take a look at this for a moment. Even if you take into consideration the unemployment rate in California at 11.5%, which is one of the highest in the United States, it does not take into consideration all the people who are no longer looking for a job or all the people in America that are underemployed. That is, they used to have a $20 an hour job, and today they've got a $7 an hour job. And by the way, they're working part-time, not full-time. So what we are seeing is the standard of living, the ability to consume products and services the world produce. We're seeing an anemic growth rate, and in many sectors, a negative growth rate. And this is going to be a drag on the economy. It's going to cause people to go into a state of fear, consume less, save more, and at the end of the day, the global economies that supply us the goods and services. And aren't we seeing this now in Germany? And aren't we seeing this now, who's a big exporter of products to America? Aren't we seeing this in Japan? They're having a very, very difficult time with their surplus capacity to produce goods and services to keep full employment. And, of course, this is now rippling through the world. So other states in America, like Michigan has a 14% unemployment rate, Oregon a 12.4%, Rhode Island and South Carolina have a 12% unemployment rate. Now, we've seen loss of jobs in multiple recessions multiple times. This is the monthly change in non-farm payrolls from 1960 through 2008. Note the gray bars in the background are periods where we had substantial recessions. The blue area are where we had job creations, and the red areas are where we had job losses. Now, the engine for new job growth in America is not government and deficit spending. The real engine for job growth in America are small businesses, not big businesses. Big businesses are multinational corporations that are taking their ability to create jobs and products and services offshore, where labor is a much more attractive rate. The real engine for job growth in America, estimated 85 to 90% of the new job growth, comes from small businesses. Now, what I believe we need in America, if you want to get jobs created again, is not a whole lot of deficit spending, but I think what we need are tax benefits and incentives to small businesses to create more new jobs. And, of course, all those new jobs that they create will pay taxes into the federal treasury. Now, this is where we're losing our jobs in America. Excuse me, these are job gains in blue. And we've gained about 2.6 million jobs since January of '06. But this is where we're losing jobs, and this is a little bit out of date. As a matter of fact, we've now created about 6.5 million jobs. And, of course, these are the areas where our job growth is significant. These are the areas where people have the highest rates of default on their mortgages, the highest rates of credit card delinquency, and the highest rates of foreclosure. So this trend is extremely well established. And what it's really starting to impact now, and you're starting to see a new trend here in America. Now, as I said earlier, not even will call, and we've got many people that are underemployed. College graduates in America, there's a new report out that at least 50% of the fresh college graduates out of a U.S. accredited institution are finding no jobs. So we're going to see this continue to play out, we believe, through the rest of this decade. Now, look at this. This is from roughly 1950 through 2010. Again, the gray bars in the background are periods where we had recession. And the duration of unemployment is, look at the trend. It is growing. It used to be, in the old days, 7.5 to 10 weeks of duration. Now it's taking 22.5 weeks, and we continue to see this curve escalate toward the upper right. So the trend is very, very much intact. There is a number as a positive. And this is a report put out by David Rosenberg, who's the former director of research for Merrill Lynch. He put this out on June 22nd this year. He said, quote, "What really struck us in the employment report a few weeks ago was the fact that the only segment of the population is actually gaining jobs is the 55-plus age category. This group gained 224 net new jobs in May, while the rest of the population lost 661,000. In fact, over the last year, the people 55 and up garnered 630,000 jobs, and the other age categories collectively lost 6 million positions." Now, this is epic. Now, I'm using his words, not mine, but this is truly a trend that we're seeing evolving. Now, why is there the older group of workers finding jobs and the young, fresh workers are not? Well, believe it or not, I think it's not only pay scale, but I believe it's the reliability. It's the fact that the older workers appreciate the employment and they show up and they deliver to their employer a high-quality workday. And some of the younger people, well, shall we say, they're doing less of that. So let's keep an eye on this trend. And what we're seeing in this recession, of course, is, and this is how we keep, what we recommend everybody at Online Trading Academy, and we teach multiple courses and we advocate and give outlines and data points for our students, who, many of which have become professional traders, or manage their own personal finances, is to keep a trading diary. Now, this is one of the most important metrics I use and have used for decades to forecast recessions and when we're coming out of a recession. And quite frankly, I believe this will be a leading indicator, not a lagging indicator. And you can get this by going to 2009research.stlouisfed.org. And this is the capacity utilization. In other words, this takes the total amount of widget factories in America, and it looks at how efficient are the owners, managers of those factories utilizing the capacity to produce goods and services. Now, take a look at this. Notice that this is from 1965 through 2010. Again, the gray bars in the background are periods where we had substantial recessions. And when industry is perking along and when companies are doing a good job, when there is plenty of demand for the products and services or near peak demand for the products and services they produce, you'll note that corporations run their widget factories at 85 to 90% capacity. But notice when the recessions come along, the capacity utilization drops off substantially. Now what causes that is old-fashioned demand destruction. When recessions come along, that means they're selling less goods and services that they produce. Therefore, their capacity utilization drops significantly. Now look where we are today. This is the curve today, and we're down here at 68% capacity utilization. And that was far worse than one of the most brutal recessions of the mid-70s, where capacity utilization was 75%. It's now down today to 7%, and we believe there is a possibility by the end of this year, given the trend of the way things are going, that it will probably be below 65% capacity utilization. Now what this tells us, ladies and gentlemen, is that CapEx spending, or capital expenditures, buying new machine tools, building new infrastructure to produce more goods and services in America, is going to be anemic. So CapEx spending is not going to bail us out of this recession, because there's no need. If you can't run your plant even at 70 or 75% capacity, there's no need to produce more capacity. Now, I want to show you a very important indicator. By the way, when we see this turn around, we will declare that the recession is near being over and that we are going to go back to a more bullish growth cycle. Let's talk about one of the most important indicators I want you to keep your eyes on, which is the Purchasing Managers Composite Index. You can also get this at the stlouisfed.org. This is from 1999 through today. The Institute for Supply Management puts out a study which they go out and interview the purchasing managers of a business. Now, I depend upon information from the purchasing managers more than I do the CEO of a company. Why is that? Because the purchasing managers, which are middle management people in the back of the plant that are actually have relationships with the vendors that supply the input goods so that a company can manufacture the finished products that their customers want to consume. So the purchasing manager has his finger on the pulse in communication with the sales team of how well the demand for the finished goods that these businesses produce, how demand looks. So when the purchasing manager's index is below 50, this is the baseline. That is very, very bearish. That means that demand destruction is still powerful and that there's no real sales growth going on. When the sentiment is above this 50 line, it's very, very positive, and it means that the purchasing managers are bullish about the future of the company to garner more market share and grow and prosper. So, ladies and gentlemen, we are truly in a global slowing economy, and it's going to continue to precipitate, at least in the eyes of our research department, a bear market. Now, what are we doing about this? Well, there's a flight to safety, there's a flight to cash, and let me go through a couple of slides here. And see if we can accelerate this along a little bit. There's a flight to safety. Cash has to be at purchase power parity. In times of deflation, cash is king. Now, what do I mean by this? Well, the fact that you're trading Forex, will tremendously help you. By the way, if any of you, this is being recorded, you could probably review this at the FX Street website, but if some of you would like copies of my slides, my suggestion is email me, just john@tradingacademy.com, and we'll put that address up at the end. I believe that there's not a lot of inflation right now, even though the central banks are printing a lot of money and there's a lot of deficit spending. It looks to me like capital is being destroyed at a faster rate than our central banks can print money. Now, for many of you, this is a very, very foreign concept to get your arms around. But let's take a look at a report that appeared on Reuters on March 11th. And you can go back to Reuters on the March 11th, do a search on Reuters' website by Blackstone Group, and this quote will pop up. This is from Blackstone Group CEO Steve Schwarzman on this date, and Reuters reported this. And remember, CEOs don't put out public statements like this unless they can back them up. And it's very rare that you'll see a statement like this in the public domain. But take a look at what, by the way, Mr. Schwarzman, for those of you that don't know, runs Blackstone Group that trades on the New York Stock Exchange. They have hundreds of billions of dollars of investments. They're the biggest private equity firm, certainly in the United States, therefore probably the world. But here's what Mr. Schwarzman said. Between 40 and 45% of the world's wealth has been destroyed in little less than a year and a half. This is absolutely unprecedented in our lifetime. Now, ladies and gentlemen, put your arms around that for a moment. What is the world's wealth? Well, it's the accumulation of the net worth of the world. Okay? It's the accumulation of the net worth of the world. And it's been 40 to 45% of it's been destroyed. He didn't say it was impaired. He said it was destroyed. These are very powerful words. Public company CEOs parse their words, parse their thoughts for public consumption. Because these kind of words can come back and bite you in the rear end and cause you a lot of trouble if you're not accurate. And he's right. This is unprecedented in our lifetime. So, ladies and gentlemen, wealth is being destroyed today at a faster pace than we can print money. I want you to think about the ramifications of that. Now let's talk about the Globalization 3.0 credit bubble and put this in perspective. This is not total debt as a percent of GDP, but this happens to be federal debt or sovereign debt as a percent of GDP. And let's take a look at some countries here and do some comparisons, because I think there's a great lesson to learn here. Federal debt as a percent of U.S. GDP is only 45% of GDP. Compare that to the UK at 50%. But look at Japan. Japan comes in here at 171% of GDP. Now, it wasn't that way. Japan's debt as a percent of GDP really started to escalate when their stock market started to melt down and their economy went into free fall starting in 1989. For those of you that haven't studied the Japanese economy, they have been in depression, not recession. They have been in depression since 1989. And their deficit spending machine went into high gear. And they have soared past America in debt as a percent of GDP. Their Fed brought interest rates all the way down to zero. They attempted to do some infrastructure spending programs as the Obama administration is proposing for America. And none of that has worked in Japan for 20 years. Now, America's not Japan. I get that. Okay? But, ladies and gentlemen, we very well could be, we need to learn a lesson from what Japan experienced in this era and not follow and make the mistakes they made here in America. Germany's debt as a percent of GDP is 39%, Canada 42%, but look at China. This is the surprise. China's debt, federal debt, as a percent of GDP is only 20%. Now, what this tells me is, as you know, China is one of the fastest growing economies in the world, and you don't need to do a lot of deficit spending, which is a Keynesian principle, to stimulate growth. Look, you produce your way to wealth. You don't spend your way to wealth. You don't borrow your way to wealth. You must produce wealth. And the Chinese government is proving that you don't need a huge debt as a percent of GDP number to stimulate a rise in productivity. Now, this is what our big deficits look like. And I think this is going to be a real tax on the U.S. dollar's credibility all the way out. As a matter of fact, this is CEO estimate, which is the Congressional Budget Office estimate, in red, and this is the White House estimate in kind of a tangerine color. I don't know if you can see that too clearly. But we're looking at probably a $2 trillion deficit. I think this is going to be a real tax on the credibility of the U.S. dollar. Now, let me give you a very interesting statistic. In the U.S., we borrow 80% of the world's savings. So 80% of the world's savers recycle their savings to America. So you need capital to run a capitalistic system. So I guess if you can't produce it, you got to borrow it. Now, I have a real problem with this, and over time, I think this is going to impact the credibility of the U.S. dollar, and I think that's why we're starting to see a trend where major countries, sovereign governments, are starting to call out for the world going off the dollar standard as a reserve currency, and they're starting to ask for and articulate the need for a basket of currencies to stand as a reserve currency for their foreign currency reserves. And I think this trend is going to probably get more and more traction, and I think we need to keep a very close eye on it, especially if we are going to continue to run these huge deficits. Now, here's the history of U.S. federal debt as a percent of GDP. Now, this is just the federal component of U.S. debt. This isn't the total credit picture in the private sector. But you can see, going all the way back to the 1800s, which again, from 1800 through 2000, this is the Globalization 2.0 era, you can see how our debt as a percent of GDP is trending. Of course, this was the huge spike in debt when we financed World War II. And, of course, this is what we believe is the future, given where we seem to be headed. Now, this is total debt as a percent of GDP. Total debt as a percent of GDP. This is both the combination of the private sector and the public sector. And I want you to note a very interesting trend. This is since 1870. So this is the last part of Globalization 2.0. Note, previous to 1920, that debt as a percent of GDP was in this era right here, around 150, 160% of GDP. In 1920, we had a big bubble boom, which led to the crash of the 1930s, where we had a credit purge cycle, and we purged out the excess capacity financed with debt in that cycle as well. And look where it goes, all the way back to this average here, which again is about 140, 150% of GDP. And we financed World War II, we financed the Korean War, we financed the Vietnam War, and as a milestone, Reagan was elected right here, and we as a culture went on this credit binge, and today we have debt as a percent of GDP at over 365% of GDP. So, ladies and gentlemen, if you take 14 trillion of GDP and multiply it by 3.65, you're going to see that we have about $50 trillion of total debt out there, both as aggregate from public and private. Now, ladies and gentlemen, this is unsustainable. This is absolutely unsustainable, and what we are going through is this credit purge And what we're going through right now is the credit purge cycle. Now, this is what our fundamental problem is as we evolve. We Americans borrow $2.5 billion a day from foreign sources. Now, this has caused our total debt as a percent of GDP since the 1970s to go from 150% of GDP to up over 365% of GDP on this scale. And the other thing is, of course, our personal savings rate has plummeted. Right here is where Ronald Reagan was president, where our savings rate was up around 12%. It fell to a negative number. Today, believe it or not, our savings rate is back up to 6%. So it's gone from a negative number in a matter of 3 years up to almost 6% today, which is an indication that we are spending less, saving more, because we are in a state of fear. And ladies and gentlemen, when the American consumer gets in a state of fear, that tells you that they don't have the purchasing power. They're tapped out as a consumer. They can't borrow money against their home and consume and use their home as an ATM as they have in previous cycles. And this is going to cause a continuing slowing in the global economy. So I think there's going to be a trend toward more cash accumulation. This is an example of how our savings rate is escalating. This is our personal savings rate in America, where it's gone from a negative number down here all the way up to this huge positive number. Now, let me kind of end on this note and see if I can open it up to a couple of questions. Ladies and gentlemen, this is the purchasing power parity. Since you're a currency trading organization, and I want to show you a trend that a lot of people don't understand. For 76 years, from 1933 through 2009, the purchasing power parity of the U.S. dollar is down over, that's correct, 94%. That's not a typo. 94% loss of purchasing power parity. So, ladies and gentlemen, you're going to need to learn to diversify. I think you need to learn to trade multiple asset classes. That's why we host classes here at Online Trading Academy in 30 centers across the world in 5 different countries. We've got a lot of free classes at our website. I would encourage you to visit our website, www.tradingacademy.com. My name is John O'Donnell. I'm CKO, or Chief Knowledge Officer, which means I do a lot of research for our company. About members, become one of our members. I encourage you to visit our website, contact one of our offices. We've got some free power trading workshops. We've got some free webinars at our website. And thank you very much. And let me answer any questions you might have. I guess we're about to run out of time. But thank you very much, FX Street. I appreciate the opportunity to address your community. My email address is john@tradingacademy.com, and I'll type it in here and put up if I can't find you, I'll put up there's my email address. John@tradingacademy.com. Boyke, I don't see your question. What is your question? Boyke. Well, what's in it for Forex trading? Look, there is a trend toward cash. People are moving out of stocks, bonds, real estate. There is a flight to safety. The number one asset class you want to learn to trade is cash and cash equivalent. And by the way, that includes gold. I look at gold as cash, the ultimate form of cash that no central bank can print. Yes, I do believe we're going to test the March lows this year in the Dow and the S&P. I expect that we will go back and retest those lows. No, I don't believe. It says, do I believe the reason for the lack of inflation? I believe the reason for the lack of inflation is not just that the money's not getting distributed, but I believe capital is being destroyed. Bond capital, equity capital, real estate equity is disappearing at a faster rate, net, than the central banks can print money. Now, I know that's a difficult concept for you to get your arms around, But remember, there's two sides of that equation. There's the existing wealth that is in place that is shrinking in purchasing power, and then there's the amount of new money that the central bank prints. The net effect is capital is being destroyed today at a faster pace than we can print money. I'll give you an example. Credit is about $50 trillion of credit out there. There's only about $2 trillion of cash out there. So what is being liquidated at a faster rate is the cash component, is the credit component. I wouldn't consider oil as cash. I would say that oil has acted as a surrogate currency. Okay? But right now, oil prices are falling. Remember, oil has gone from $147 a barrel below 60 today. It is not the end of the world, and we're not going to have an end of the world. The world is not going to end, Boyke. That's my good news message for the day. No, I don't believe the bear market's over. I believe we are in a secular bear market. I believe it will run through the end of this decade. I believe we are in a cyclical rally that started March 9th, but I do not believe the bear market is over for multiple asset classes. Now, I don't know which market you're talking about. I assume you're talking about the stock market, and I don't think the bear market's over for real estate either. Can I comment on the USD move this week? Well, look, there's a flight to safety. Which currency issued by a sovereign government is perceived to be the safest? There's a rush to smart money is moving to a safe harbor in the port of a coming storm. I believe what we need to do is buy gold on weakness. I think what you should do is be accumulating gold and buy it on weakness. Look, I've got to go. Visit our website. There's some free webinars there. We've also got a free newsletter known as Lessons from the Pros, and we have another service called Hour with the Pros. Check on Online Trading Academy office. You can get a free subscription to all those services. God bless you all. Good luck. Stay liquid. Good luck.